If you're putting money into your company's retirement plan, or if you are a plan sponsor with oversight of your company's plan, listen up. Right now, there's a national debate over whether private investments, things like private equity, private credit, and other alternatives, should be added to workplace retirement plans. For some investors, that could mean new opportunities to diversify and grow wealth. For others, it raises big questions about fees, transparency, and risk. Today, we're breaking it all down in plain English. And before I introduce this week's special guests, I want to share that we've created a free supplemental guide that breaks this all down for you. Make sure you grab it after the interview by scanning the QR code on your screen or clicking the link in the episode description. All right, joining me today are two strategic leaders here at Prime Capital Financial, and if I may say so, two people who are my personal financial professional celebrities. Can I get an autograph, please? It's my pleasure to introduce Scott Duba, our Chief Investment Officer and President of Wealth, and Jania Stout, our President of Retirement and Wellness. They've both been following this situation closely, and we're going to get their perspective on what it really means for you, whether you're an investor or a plan sponsor. All right, Scott, I want to start with you. You said before that it shocks you more people know about crypto than private equity. Why is that, and what are one or two key things the average 401k participant should understand about private assets?
Yeah, so I think one stat that everyone should be aware of is that the majority of companies in America with over $100 million of revenue are actually private. So when you hear the words alternative investments and private investments, think of it as a whole new asset class that we didn't have access to before, that because of democratization of these various investment vehicles, we now have the ability to potentially invest in. So it surprises me that people don't know that. I think the reason is cryptocurrencies tend to be a little bit more salacious. People talk about them more in the media. When in order of size and opportunity, I think the private markets are actually substantially larger and potentially much more impactful.
So it sounds like there's this flashy thing that people have been drawn to, but there are some other fundamental opportunities that we need to get some more education around. So Jania, let's flip to the employer side. Plan sponsors are asking, if we add private assets, are we exposing ourselves to more risk? What's the reality there?
The reality is yes. I mean, anytime you offer any type of investment vehicle inside of a qualified retirement plan, you have fiduciary oversight to make sure that those investments are suitable for the employees that are being offered that asset. So it is something that plan sponsors need to be aware of, that there is still that fiduciary oversight that is needed, and they should be taking this seriously from a committee standpoint and relying on great advisors like we have here at Prime Capital.
We love our advisors. We talk about them almost every week. So private markets sound exciting, but they're not free. There are higher fees, less liquidity, and a lot more complexity. So Scott, walk us through some of the pros and cons.
Sure. So I'd say one of the major benefits is just diversification. Over the past 20, 30, 40 years, as the private markets have developed, more companies are staying private for longer and are not even entering the public market. So the number of public companies in America has almost been cut in half over the past 20 or 30 years, and the number of private companies that are growing and emerging has gone up, because as these markets have evolved, these founders, the entrepreneurs, these business owners can get access to capital via the private markets. So that's the big plus. One of the negatives is just there's less transparency, and you got to do your homework a little bit more. Private markets are by definition private, which means they're not liquid. Typically about 8 out of 10 Americans in retirement plans are familiar with stocks and bonds on public markets, but only about 4 out of 10 are aware of even what private equity, private credit, private infrastructure funds are. So there's a fair amount of education that needs to take place so that people actually know what they're buying and making sure they're investing in high quality private markets.
And that's why we're here, right? Educating our audience. So for employees, terms like private equity don't mean much, just like Scott outlined. Jania, how would you explain the basics in a way that's clear and simple, the upside, but also the fine print when you're talking to plan participants?
Yeah, I mean, I think that it's really important from a participant perspective, so the employees that work for the companies that are offered this, that they understand what it is. And I think that it gives them more diversification or access to an investment that they've never had access to before. But I will say that our thoughts are that this isn't going to be an investment that employees are going to go out and it's not going to be on a fund lineup and they actually pick how much they want to allocate to that private asset. I mean, that could happen, but I would say from our perspective, we think that the privates are better suited to be embedded either in a target date fund or in an advisor managed account. And in those two scenarios, I think the conversation with the employee is just more about talking to them about their goals and their risks. And they don't have to become an expert in that underlying investment if we're managing their assets for them in some type of managed account. So, because otherwise, Tara, I think it would be a big hurdle to try to educate every employee on that exact asset class. So that's why it's better suited for an advisor managed account where we take over discretion and we're the ones responsible for selecting which private asset we put in that portfolio or not.
I think that's a really helpful distinction, especially for plan participants. I can say, and I think I've shared before in lots of different conversations, that when I was young, I was in my early 20s and just starting to participate in a 401k. I didn't even know what vesting meant. So I think that you're right, that we can start to get a little bit ahead of ourselves by talking about these very specific and complicated things, but really you have a plan sponsor for a reason. We just want to make sure that plan participants are also feeling like they understand what's going on. So I think that's a great distinction, Jania. Scott, coming back to you, most participants never change their default target date fund. If private assets become part of that mix, what's your message to them in plain English? How do they stay smart, avoid mistakes?
I think it's know what you own in simple terms. Private investments tend to be, like we said, less liquid, and they tend to be less transparent and usually have a little bit higher fees. So you really want to make sure that your allocation, either within a plan lineup or a target date fund, matches your risk tolerance. Target date funds are great, kind of one-stop shops to kind of get you on the right glide path. But as circumstances change in your life or your career or your age, you want to make sure you're revisiting how you're allocated and make sure higher position and make sure it's consistent with your long-term goals.
Kind of going back to Jania's comment around our great advisors, right? You have an advisor to your plan, most likely, so they're there as a resource. You should talk to them. Jania, turning to you to kind of wrap things up, we know behavior is half the battle in retirement, right? So if private assets come into the lineup, how do you make sure participants aren't overwhelmed and that education is part of that overarching wellness strategy?
Yeah, Tara, it's a great question. I talk about this quite a bit, that my hope is that plan sponsors or companies, I'm trying to not use the lingo, industry lingo, when a company offers a 401k and maybe they have an automatic enrollment in their plan and they auto default them to a target date fund, I don't want them to stop there. We have to continue to educate. Our financial wellness study that we do every year shows that most employees are still stressed and don't know if they're saving enough or if they're in the right investment vehicle. So what does that tell us? It tells us that our job is not done just if we do auto solutions to a target date that might have a private asset in it, right? So we need to continue to educate, and that's just going out on site, doing virtual meetings, webinars, tracking it. It's something that we're super, super passionate about. And I think making, like Tara, you say it all the time, say it in simple, plain English. Most employees won't really understand this. They'll read the headlines or they'll be at the water cooler and think like, oh gosh, I need to be in private markets. Our job as the advisor is to help de-stress their lives and make it simple. And it's really just keeping simple communication and education.
That's great. That's a really great way to wrap things up. So this is one of the biggest questions facing retirement savers today. Should private investments be part of your 401k? Scott, Jania, and I agree. There's way more to discuss here. And in that spirit, we plan to share even more educational content in the coming weeks. So stay tuned. And if you want to take the first step and begin to understand how this all could impact your financial future, download our supplemental resource by scanning the QR code on your screen or clicking the link in the episode description. This piece is really designed to just kind of reinforce the facts that we talked about today, the questions to ask, and the tools you need to make smarter decisions about your retirement savings. Because at the end of the day, the goal isn't just to save, it's to save smart, and that means being informed. Huge thank you to our special guests, Scott and Jania, for sharing your professional perspectives today. And thank you, dear audience, for watching. Remember to stay informed, stay invested, and as always, we'll be here to help you navigate the twists and turns of the market. Until next time.